Imagine waking up, checking your phone, and seeing that the silver market, a market that has been the cornerstone of the greatest wealth transfer of 2025, just wiped out $10 of value in a single 60-minute window of absolute carnage. If you are holding physical silver miners, or paper contracts, the sight of that vertical red line on the chart was enough to make your heart skip a beat. We are witnessing one of those most volatile periods in the history of precious metals. And what happened today wasn't just a random fluctuation. It was a systemic shock that has every investor asking the exact same question. Is the historic rally to $84 an ounce officially dead? Or is this the greatest buying opportunity of our lifetime? Before we break down the secret data from the CME Group, the massive shift in Chinese export laws, and the technical levels you must watch to protect your wealth, do me a massive favor and hit that subscribe button right now and turn on all notifications. This market is moving faster than the news cycle can keep up with, and our goal on this channel is to keep you ahead of the institutional smart money that is currently trying to shake you out of your position. If you find value in this deep dive analysis, give this video a thumbs up so the algorithm can spread this warning to other silver stackers before they panic sell at the bottom. The silver market just did something it hasn't done in nearly half a century. After a parabolic 180% rally that saw prices scream toward the mid-80s, the floor didn't just crack, it disintegrated. To understand if this rally is over, we have to look at the anatomy of that $10 drop. According to the latest reports from Yahoo Finance and market analysts on the ground, silver's pullback was triggered by a perfect storm of technical exhaustion and aggressive regulatory intervention. For weeks, silver had been defying gravity, fueled by a massive supply deficit and an insatiable appetite from industrial sectors in the East. But as the metal hit $84, it became what traders call overextended. It was trading nearly 90% above its 200-day moving average. In the world of finance, when a spring is coiled that tightly, the release is never a gentle bounce. It is a violent snap. The catalyst for the 60-minute crash wasn't just people taking profits. It was the CME Group stepping in and changing the rules of the game mid-match. They hiked the margins for silver futures from $20,000 to $25,000 per contract. For the average person, that sounds like a boring technicality, but in the world of high-leverage trading, that is an absolute death sentence. When margins go up, traders who don't have the extra cash on hand are forced to sell their positions immediately, regardless of the price. This created a forced liquidation cascade. As the price started to slip, it triggered stop-loss orders, which led to more selling, which led to more margin calls, and within an hour, the silver squeeze of 2025 felt like it was turning into the silver slaughter. But there is a much deeper story happening beneath the surface of this price action, specifically involving the geopolitical chess match between the United States and China. While the Western paper markets were crashing, the physical demand in the East remained shockingly resilient. We are currently looking at a massive divergence between the price you see on a screen and the price required to actually get your hands on a physical kilo of silver. This crash has left retail investors in a state of shell shock. But if you look at the historical context provided by the recent market data, a 10 to 14% pullback after a 180% run is not just normal, it is healthy. In 1980, during the famous Hunt Brothers era, silver didn't go up in a straight line. It had massive, gut-wrenching corrections that shook out the weak hands before making its final moonshot. The question we have to answer today is whether we are in a repeat of 1980, or if we are in a brand new paradigm where silver is no longer just a precious metal, but a critical industrial mineral. The United States government recently gave silver that exact designation, acknowledging that without it, the green energy transition, the AI revolution, and the future of high-tech weaponry simply cannot exist. When a commodity moves from being a speculative asset to a national security priority, the price discovery process becomes chaotic. The $10 drop we just witnessed might be the institution's last attempt to grab cheap physical metal before the new Chinese export regulations go into effect on January 1st, 2026. If you look at the volume profile during that 1-hour crash, you see something very interesting. While the price was plummeting, the volume was record-breaking. This indicates that for every panicked seller, there was a massive institutional buyer waiting on the other side of that trade to scoop up the metal at a discount. They want you to believe the rally is over. They want you to think that silver is going back to $20. But the fundamentals, the actual physical ounces available in COMEX and London vaults, tell a completely different story. We are currently facing a global silver deficit that has persisted for several consecutive years, and a 1-hour paper crash does not create more silver out of thin air. It doesn't build new mines, and it doesn't slow down the demand for solar panels in China or electric vehicle components in Europe. As we analyze the fallout of this crash, we have to look at the psychological impact on the silver squeeze community. Many people bought in at $70, $75, and $80, thinking it would never stop. Now that they are seeing red in their accounts, the fear and greed index has swung violently toward extreme fear. This is exactly where the big banks want the retail public to be. They use these margin hikes as a tool to create volatility, knowing that the average investor cannot stomach a $10 drop in an hour. But if you are a long-term stacker, you know that the price on the screen is a lie. The real value of silver is determined by its utility and its scarcity. When we see the price pull back to the $74 level, we are seeing the market attempt to find a new floor. If that floor holds, the next leg up could be even more explosive than the last. We are looking at a situation where the paper to silver ratio is reaching absurd levels, and the disconnect between the COMEX and the physical reality is about to reach a breaking point. The historic 2025 rally was driven by a fundamental shift in how the world views silver. It is no longer gold's poor cousin. It is the most essential metal of the modern age. Every single Tomahawk missile contains 15 kilograms of silver. Every solar panel, every cell phone, every medical device, it all requires silver. And unlike gold, silver is being consumed. It is being buried in landfills inside discarded electronics. We are literally throwing away the most important industrial metal on the planet while the demand for it is skyrocketing. This is why the 1 hour crash, as painful as it was to watch, is likely a distraction from the bigger picture. We need to talk about what China is doing right now, because their move to implement export licenses for silver is perhaps the single most important event in the history of this metal, and it is being overshadowed by the short-term price volatility. To truly understand why this 1 hour crash is likely a trap for retail investors, we have to look across the ocean at the seismic shift occurring in Beijing. While the Western media was focused on the red candles on the COMEX chart, China quietly finalized a policy that could permanently alter the global availability of silver. Starting January 1st, 2026, just days from now, the Chinese Ministry of Commerce is implementing a strict government licensing system for all silver exports. This isn't just a minor bureaucratic hurdle, it is a strategic lockdown. Under these new rules, only large, state-sanctioned firms with documented high-volume production and pristine financial records will be allowed to ship silver out of the country. This move effectively cuts off the dozens of smaller refiners and secondary market suppliers that the West relies on to balance the physical market. Why does this matter? Because China isn't just a participant in the silver market. They are the world's second-largest silver producer and the undisputed king of silver refining. By tightening the faucet on exports, China is essentially signaling that they view silver as a strategic reserve for their own industrial dominance. They are prioritizing their internal solar panel manufacturing and their massive EV sector over the needs of the global market. Even Elon Musk took notice, retweeting the news with a stark warning. This is not good. Silver is needed in many industrial processes. When the richest man in the world, whose companies consume a massive amount of this metal for everything from Starlink satellites to Tesla circuit boards, expresses public concern about supply, we are no longer in normal market territory. While the paper price plummeted $10 in an hour due to margin hikes, the physical reality is that the world is heading into 2026 with a massive supply-side hole. We are entering our 5th consecutive year of a structural silver deficit. In 2025 alone, the shortfall was estimated at nearly 95 million ounces. Since 2021, the cumulative deficit has ballooned to over 800 million ounces. You cannot fix an 800 million ounce hole by raising margins on a digital exchange in Chicago. All the CME did today was shake out the people who were trading on borrowed money. For those who own the physical metal, the fundamental case has actually gotten stronger because of this volatility. It reveals just how desperate the institutions are to prevent a true breakout before they can secure their own stockpiles. Adding fuel to this fire is the United States' own reaction. In a historic move on November 6, 2025, the U.S. government officially added silver to the critical minerals list. This is a game changer that most mainstream financial news outlets are completely ignoring. By classifying silver as critical, the U.S. has admitted that the metal is essential to national and economic security and is vulnerable to supply chain disruptions. This opens the door for something called Section 232 tariffs. Historically, precious metals were treated as monetary assets and spared from trade levies. But now that silver is a critical mineral, it could be hit with import tariffs ranging from 15% to 50% in the name of national security. Imagine the chaos. China restricts exports, and the U.S. adds a 50% tax on whatever metal does manage to make it through. If you think $84 was the top, you haven't seen what happens when a critical mineral goes into a geopolitical bidding war. This is why silver has been the star of 2025, outperforming gold by a massive margin. While gold saw an impressive 70% gain this year, silver exploded by 150%. The gold to silver ratio, which spent years hovering in the 80s and 90s, has been collapsing as investors realize that silver is the utility metal of the future. The recent pullback from $84 down towards $70 is simply the market pausing to catch its breath. From a technical perspective, we are watching the $70 level like a hawk. This was a major psychological barrier. If the price holds above 70, it confirms that the old ceiling has become the new floor. If we slip below that, the next major support zone is at $60, followed by the ultimate support at $50, the legendary peak from 1980 and 2011. However, looking at the data from the COMEX and the LBMA vaults, there's very little available silver left to keep the price down for long. We are seeing a phenomenon called backwardation, where the price of silver for immediate delivery is higher than the price for delivery in the future. This is a massive red flag. It tells you that there is a desperate shortage of metal right now. In a normal market, you pay a premium for future delivery to cover storage and insurance. When that flips, it means the market is broken. Big industrial buyers are willing to pay more today because they are terrified they won't be able to get the metal tomorrow. This is the liquidity squeeze that triggered the CME's emergency margin hike. They saw the system redlining and hit the emergency brake. But the brake only works for so long. The demand from the AI revolution is just starting to hit the silver market. AI data centers require high-performance connectors and advanced cooling systems, both of which rely heavily on silver's superior conductivity. We are moving into a world where silver isn't just something your grandmother keeps in a cabinet. It is the blood of the digital economy. Every breakthrough in AI, every new 5G tower, and every satellite launched by SpaceX makes silver more valuable. And yet, silver mining is incredibly inelastic. You can't just flip a switch and mine more silver because most of it is produced as a byproduct of lead, zinc, and copper mining. If those industries slow down, silver production drops, regardless of how high the price goes. So, when you see a headline saying silver pulls back from record, don't look at it as a failure of the rally. Look at it as a restructuring of the market. We are transitioning from a speculative hype phase into a strategic acquisition phase. The big players, JP Morgan, the Chinese central bank, and the industrial giants, are using this volatility to scare you into selling your paper silver so they can back up the truck and take delivery of the physical bars. They know that once January 1st hits and the Chinese export licenses become a reality, the game changes forever. The historic rally of 2025 isn't over. It's just getting its second wind. We are entering a new era of resource nationalism where the countries that have the metal make the rules. The volatility we are seeing right now is a direct symptom of what I call the physical vacuum. While the CME raised margins to cool down the paper markets, they cannot cool down the literal vacuum of silver leaving the vaults. In late 2025, we saw a record-breaking 187 million ounces move into exchange-traded product holdings in just a few months. This isn't just retail investors. This is institutional capital realizing that silver is the ultimate asymmetric bet for 2026. The gold to silver ratio, which has historically spent time near 80-1, has been collapsing toward 50. This tells us that silver isn't just tracking gold anymore, it is detaching. It is becoming its own asset class, driven by the sheer necessity of its atomic properties. To understand the scale of the crisis that caused this $10 crash, we have to look at the secret demand sectors that most analysts are too afraid to touch, specifically military applications. Every single Tomahawk cruise missile contains up to 500 ounces of silver. In 2025, with global geopolitical tensions at an all-time high and stockpiles being depleted in multiple conflict zones, the Department of Defense has become a massive, silent buyer of silver. They aren't buying on the COMEX with leverage. They are taking physical delivery to ensure that the production lines for precision-guided munitions never stop. When the military classifies a metal as critical, it means they are prepared to outbid everyone else for it. This creates a price floor that the paper traders simply cannot break, no matter how many margin hikes they throw at us. Then there is the artificial intelligence factor. We all know silver is essential for solar panels, but the AI revolution is the new X factor for 2026. High-performance data centers require an immense amount of silver for high-speed connectors and semiconductors, because silver is the most electrically conductive metal on Earth. There is no substitute. If you want AI, you need silver. If you want the green energy transition, you need silver. And right now, the world is realizing that the 820 million ounce cumulative deficit we have built up since 2021 is a debt that must be paid. You cannot simply print more silver like you can print the dollar. You have to find it, mine it, and refine it, a process that takes a decade. This is why the 1 hour crash was actually a gift for those who understand the fundamentals. While the price on your screen flashed $73, the physical premium in Shanghai stayed elevated above $80. This arbitrage gap is a signal that the West is losing control over the price discovery of silver. For the first time in history, the East is setting the real price. If the Shanghai Gold Exchange continues to demand a $10 premium over the New York price, the metal will simply flow to where it is valued most. We are watching the great silver migration from west to east. And once that metal enters Chinese vaults, it is likely never coming back. As we move toward the January 1st deadline for China's new export licenses, the historic 2025 rally is transitioning into the 2026 supply shock. The big banks know this. Reports are circulating that JP Morgan has shifted from its decade-long short position to holding one of the largest physical silver stockpiles in history. Why would the most powerful bank in the world suddenly change sides? Because they see the writing on the wall. They know that $84 was just a preview. They know that when 70% of the world's refined silver supply is locked behind Chinese licensing requirements, the price will no longer be determined by margin requirements or paper contracts. It will be determined by who has the physical ounces and how much the tech giants are willing to pay to keep their factories running. The question isn't whether the rally is over. The question is whether you are prepared for the next leg up, which could see silver challenge the psychological $100 mark. This recent $10 drop was a shakeout, designed to clear the board of speculators so the true move can begin. If you can hold through this volatility, you're positioning yourself on the right side of a structural shift that only happens once in a century. We are moving from a world of financial abundance to a world of resource scarcity. In that world, silver is king. The reality we are facing as we turn the page into 2026 is that the paper market and the physical market are now two entirely different entities. What happened in that 60-minute window on December 29th was a surgical strike by the establishment to reset the psychological expectations of the masses. By slamming the price down from $84 to the low 70s, they created a narrative of failure. But if you look at the exchange data from the Shanghai Gold Exchange or the premiums being paid on the streets of Mumbai, you see a completely different world. In those markets, silver didn't crash. It simply became harder to find. We are witnessing a decoupling of value, where the digital price used for bank balance sheets no longer reflects the cost of acquiring the actual physical atoms of the metal. This is the great divergence that will define the next 12 months. While the CME Advisory 25393 effectively raised the barrier to entry for the common person, the ultra-wealthy and sovereign nations are moving in the opposite direction. They are bypassing the COMEX altogether and going directly to the miners to secure off-take agreements. They know that once the Chinese export licenses take effect on January 1st, the global supply of refined silver could drop by as much as 60 to 70%. Think about that for a second. In a world where demand is already outstripping supply by nearly 200 million ounces a year, we are about to lose the majority of the world's refining capacity. This isn't just a pullback, it is the setup for a global supply squeeze that will make the 1980 Hunt Brothers era look like a minor ripple in a pond. For those of you feeling the FOMO, or the fear of loss right now, I want you to consider the timeline of a critical mineral. When the US government officially listed silver as a critical mineral in November 2025, they weren't doing it to help your investment portfolio. They were doing it because the military-industrial complex is terrified. We are entering an era of resource nationalism, where having the metal is more important than having the currency. If you have $10 million but no silver, you cannot build a satellite. You cannot build a missile guidance system. You cannot build the high-speed servers required to run the AI models that are now driving the global economy. In this new paradigm, the price is secondary to access. The $10 drop was the institution's way of ensuring they have the access while you have the fear. Technically, the road to $100 is now wide open. Yes, the volatility is sickening. Yes, seeing 10% of your net worth evaporate in an hour is a test of character. But look at the monthly chart. Silver has spent the last 40 years in a massive macro consolidation pattern. We have just broken out of that multi-decade cup and handle formation. In technical analysis, the longer the base, the higher the space. A 40-year base doesn't result in a 3-month rally. It results in a multi-year structural repricing. Most analysts are now projecting that silver will average between $60 and $80 in 2026, with spike potential well over triple digits, if the gold to silver ratio continues its historic collapse toward 40 or even 30 to 1. We are currently in the eye of the storm. The margin hikes of late December 2025 are the last-ditch effort to keep the lid on a boiling pot. But the pot is already melting. The physical vaults in London and New York are at their lowest levels in recorded history. The paper-to-silver ratio, the number of digital ounces traded for every one physical ounce in existence, has reached an absurd 350 to 1. This is a house of cards waiting for a breeze. And that breeze is coming on January 1st, when China shuts the door. If you are holding physical silver, you aren't just holding an investment. You are holding a get-out-of-jail-free card for the coming financial reset. You are holding the one asset that cannot be devalued by a central bank and cannot be replaced by an algorithm. As we move into 2026, keep your eyes on the lease rates in London. When it becomes more expensive to borrow silver than to buy it, you know the endgame is near. We are seeing those rates spike to levels not seen since the 2011 peak. But this time, the industrial demand is 10 times higher. This time, we don't have the moderate cushion of massive central bank stockpiles to dump on the market to keep prices low. The world is out of silver, and the only way to get more is to pay a price high enough to convince someone to stop using it. That price is not $73. It is likely not even $100. We are heading toward a value reset, where silver finally claims its throne as the most undervalued asset on the planet. So, is the historic 2025 rally over? Not by a long shot. This was just the opening act. The crash you saw today was the clearing of the stage before the real drama begins. The smart money is using this dip to accumulate. The sovereign funds are using this dip to secure their industrial futures. The question is, what are you doing? Are you letting the paper price dictate your emotional state? Or are you looking at the cold, hard facts of the physical deficit? The 2026 silver squeeze is coming, and it will not be televised until it is too late to join. If you made it this far, you are part of the 1% of investors who actually dig into the data rather than just reacting to headlines. You understand that true wealth is built during times of maximum pessimism. If you found this 4,000-word deep dive helpful, please share it with one person who is currently panicking about their silver position. Let IS help them see the bigger picture before they make a decision they'll regret for the next decade. Don't forget to check out our previous video on the hidden military demand for silver, which explains why the Pentagon might be your biggest competition for metal in 2026. Keep your stacks heavy, your mind sharp, and your eyes on the physical market. I'll see you in the next one.